Welcome back to the channel, everyone. Today, we're diving deep into a situation that has started turning heads across the investing world. When a company's leadership begins buying large amounts of its own stock, it often sends a message that insiders believe the market severely undervalues the business. And right now, that's exactly what seems to be happening at Fiserv. Over the past several weeks, insiders, including top executives, have purchased more than $2 million worth of shares, and that type of conviction is rare. Many investors are now wondering if the stock could deliver meaningful upside in the coming years. In this video, we'll break down why insiders may be stepping in so aggressively, what the company's recent challenges mean, how its financials are shaping up, and whether this could be a setup for a significant recovery. So, without anything to display on screen and keeping things purely narrative, let's unpack the full story. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Insider buying is often one of the strongest signals in the market because executives know their company more intimately than anyone else. When those closest to the operations decide to use their personal money to acquire shares, it suggests they perceive a mismatch between the stock price and the underlying value of the business. Right now, that appears to be the case with Fiserv. The company recently experienced a dramatic decline, around 70% over the past year, and a single-day drop of roughly 40% that left many investors uneasy. But while the broader market may be panicking, the insiders are behaving quite differently. The CFO alone executed a purchase of more than $1 million, and when you combine that with buying from two other insiders, the total passes $2 million. Moves like these don't happen casually. They usually reflect internal confidence that the current price dramatically undershoots the company's true worth. The earlier collapse in the stock wasn't caused by just one event. Instead, it was the result of the prior CFO's departure, a shift in expectations, and management's decision to reset long-term growth targets after years of consistent double-digit expansion. When investors see leadership turnover combined with reduced outlooks, fear tends to take over. It becomes a classic sell first, think later type of reaction. Concerns also surfaced around Fiserv's leverage profile. Since the company carries debt, any perception of slowing performance triggers questions about whether problems behind the scenes could be deeper than expected. It's the investing version of wondering whether one visible issue hints at multiple hidden ones, similar to spotting a cockroach and worrying there are dozens more. And the market wasted no time pricing in that fear. But now that insiders are actively buying, the market is entering the second phase of reassessment, when panic cools down and rational analysis steps back in. Executives appear to be asking themselves, has the stock dropped far below its actual value? And their purchases suggest the answer is yes. After the painful decline, Fiserv still remains a business that's growing, maybe not explosively, but steadily. It's not a shrinking iceberg melting into nothingness. Instead, it's a company with stable, recurring revenue streams and segments that continue to perform well. For example, Clover, one of Fiserv's standout platforms, is expanding aggressively in the small and medium-sized business market, posting growth rates of about 26%. That's substantial outperformance compared to the company's overall growth rate and indicates Fiserv still holds valuable assets with significant potential. However, not every piece of the company is equally strong. Some legacy operations are struggling. Traditional processing has become a commoditized service, meaning increased competition and shrinking margins. While Clover shines, the broader small business segment only grows at around 7%, and older financial products for banks have faced pressure. In the most recent quarter, financial solutions revenue shrank roughly 3%. Although these segments remain profitable with incredibly high operating margins, often in the 30% to 40% range, the core challenge is that high-margin sectors attract aggressive competitors. When a business produces such rich profitability, rivals inevitably try to claim a slice, even at lower margins. So, while Fiserv's revenue remains sticky due to long-term contracts and entrenched systems, not all parts of the company are gaining ground. Management has also been transparent about increasing capital expenditures. Following the leadership transition, the new CEO and CFO felt the company needed to clean up expectations and refocus on disciplined, sustainable growth. As part of this reset, they plan to reinvest more heavily into the business, raising capital spending from earlier levels near $1.5 billion to closer to $1.8 billion. That increase naturally squeezes free cash flow in the short term. The company, which once delivered around $4.6 to $4.7 billion in free cash flow, now forecasts something nearer to $4 billion. This decline contributed heavily to the drop in the stock price. Yet even after the revision, generating over $4 billion annually puts Fiserv in rare territory. Few companies on earth produce that kind of consistent cash, and this is precisely why the insider buying becomes so important. It signals that management believes the company can maintain that enormous cash generation despite the adjustments. Using today's market cap of roughly $35 billion, with free cash flow around $4 billion, the company trades at around 7 to 8 times free cash flow. For investors, that represents a yield equivalent of about 12% to 13% if the company simply stays flat. That's before considering buybacks or any organic growth. When insiders run those numbers, it's easy to see why they might feel the current price is unjustifiably low. Historically, companies trading at such multiples often outperform broader indices, and adding just moderate growth, say 5%, pushes an investor's potential annual return into the high teens. There just aren't many opportunities where you see this combination: high margins, substantial recurring revenue, sticky customers, and a single-digit cash flow multiple. The CFO isn't buying because the stock looks average. He's buying because the valuation looks exceptional relative to the company's long-term profile. Management also stated that a portion of future free cash flow will go towards share repurchases. Even with debt obligations in place, they project at least a 5% annual reduction in share count. Combining buybacks with valuation recovery can create powerful returns. If the market simply re-rates Fiserv to something closer to 15 times free cash flow, a level still below the typical U.S. market multiple, the market cap could rise to upward of $63 billion. Add in ongoing buybacks, and investors could see the share price rise from around the mid-$60 range into the $120 area over the next 2 or 3 years. That's roughly a 100% potential return, which aligns with what many analysts estimate. This is why some traders and deep value investors are taking a closer look. It's not about betting on explosive innovation. It's about betting on valuation normalization and consistent cash flow. Long-term growth investors, on the other hand, may hesitate because Fiserv's growth rate doesn't fit the profile of the hyper-growth companies they typically chase. The debate ultimately centers on the classic Peter Lynch principle. Slow-growing businesses rarely deliver spectacular long-term stock returns. Lynch famously avoided companies expanding only 2% to 4% per year because their limited growth caps long-term upside. Yet he also acknowledged that deep value opportunities, companies with strong cash flow but temporarily depressed valuations, could deliver strong gains during recovery phases. Fiserv fits somewhere in the middle. The company isn't falling apart, but it isn't racing ahead either. Its cash flow is stable, its margins remain remarkable, and insiders clearly believe the future looks far better than the current stock price suggests. For short-term or medium-term investors, this kind of setup can be compelling. For long-term growth investors, the journey depends on whether they're comfortable owning a business that may rely more on valuation shifts and buybacks than on double-digit organic expansion. To wrap things up, Fiserv looks like a company that the market punished far more severely than its fundamentals deserved. After leadership changes, lowered expectations, and a strategic reset, investors reacted with fear, driving the stock down dramatically. Yet despite the panic, insiders have stepped in with more than $2 million of their own money, including a major purchase from the CFO. That level of insider confidence suggests they believe the business still has durable strength, strong cash flow, sticky customer relationships, and high-margin segments that many competitors would envy. While growth may stay moderate, the valuation alone provides room for significant upside if sentiment shifts back toward normal levels. With buybacks, stable operations, and insiders signaling long-term faith, Fiserv appears positioned for a meaningful recovery in the years ahead. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.